Is it all good now that the U.S. labor market is withering, or so it would seem, and so the Fed can stop the floggings? Or are we still looking out for a global recession on the horizon? You'll be surprised that I am not terribly optimistic. Welcome to Macro Money. This is Ilya Spivak, head of global macro here at tastylive, and the markets are certainly feeling a little bit cheerier today, but we're going to get a little bit of economic data here in the coming 24 hours that may cool their jets just a bit. And as ever, the focus is on what are the consequences of the Fed tightening that's already occurred, coupled with a global economy that, of course, does its own things and has its own responses to all of these things. In addition to the very active speculation happening in markets about what the Fed is going to do next. So the very near term, will they or won't they hike conversation. And so what we're going to focus on today is a couple pieces of data due with us in the next day here that will show that the world's biggest economies, the US and China, are in a sense diverging. And what this means for this global recession risk that we've been watching here on Macro Money, and that looks like it was a big story for markets through the month of August, hence much of the weakness that we'd see in risky assets, and how that may continue to develop as the year continues. So let's begin with China. That's where the data that we're going to be talking about here is first to drop. And here we're going to get the August set of PMIs. This is the CFLP version, the official version from government entities in Beijing. It's going to be side by side once all of the data cycle is through with a competing survey from S&P Global and Caixin, which will be a private sector estimate. The two tend to say the same things, broadly speaking. The official numbers focus more on large and oftentimes with a significant component of state ownership type of enterprises that they survey for this, whereas the Caixin one focuses on smaller firms. And you get a complete picture between the two. We're going to get the first batch, which will be the official numbers here. And as you can see, they do not point in a positive direction. You get further slowdown, it would seem, in service sector activity. So just to remind ourselves here, the PMI data sets work around an axis of 50, where 50 is neither contraction nor expansion of the sector that we're looking at. Above 50 is growth, below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. And so what we're looking at here is the service sector having had a nice healthy pop at the start of this year, and in so doing pooled the composite number, capturing the overall economy. With it, that pop linked to a burst of domestic demand, thanks to China finally scrapping its zero COVID lockdowns and reopening the economy. That looks to have crested, and we are now back in retreat. It was a fairly short-term pop that essentially fizzled before the middle of the year. And we are now very much going the other way and sinking ever closer to economic standstill. The composite index expected to register just a hair above that 50 line. Manufacturing, of course, has been in contraction for months under 50 and is expected to remain there. The pace of contraction looks like it might accelerate a hair, but the upshot remains the same. China's all-powerful export sector, which is so much of the growth story there, that continues to shrink. So just by way of a bit of background, here's what's going on here. China reopening in December of last year came over a year, and in some cases about a year and a half, give or take, depending on whether you look at the US or the Eurozone, after the peaks in post-pandemic catch-up growth for its main customers. So not surprisingly here, the places where there are big concentrations of rich consumers are where the main end destinations are going to be for China, in that it is or has been the leading center for value add work in the global supply chain. So raw materials come into China, they are put together or processed or variously transformed into either finished goods or intermediate goods that later will be finished elsewhere. Components come in from the likes of Taiwan, Korea, Japan, elsewhere, the US, and are assembled either fully or some of the way. And so some value add work is done to go from inputs, whether they be raw material inputs or sort of a prefabrication set of inputs. Some value add is done, and then those things are either shipped on to where more value add work will be done or shipped on to where these things are going to be finally sold. And what you see is that, of course, the consumers powering all of this tend to be in the US and the Eurozone. And you can see that demand there had a sharp surge thanks to stimulus and a much earlier exit from COVID restrictions over a year before China decided to rejoin the party. So the U.S. growth spurt catching up momentum was something that peaked in May of 2021. In the Euro area, it peaked in July of 2021, so just 2 months later. And so when China re-entered the market and said, hey, this big value add node is now back open for business, there was a tremendous period of time there where things still needed to be shipped to the US and the Eurozone. There was still demand that needed to be filled, but the supply chain had to shift. And so there was a readjustment. Furthermore, by the time China came back, both of these economies were already dealing with a significant interest rate hike cycle. Obviously more aggressive in the US than in the Eurozone, but nevertheless, both of these central banks, the Fed and the ECB, were well into a very aggressive inflation fight at this point. And so growth was being driven lower. So China reopened into an environment where its capacity to drive growth as it did before by being the sort of assembly workshop, bar none, for the global supply chain, that engine simply has not been able to be rebooted in any kind of a meaningful way because demand has not been there. Certainly not to levels akin to the pre-pandemic normal, both because demand itself is lower because these economies are slowing, the end demand economies, but also because there was a big gap there where there was an opportunity to diversify supply chains away from China, and that opportunity was taken. So what we see here is, as we look at the direction of global trade, this is data from IMF, and it's only caught up to April at this point. In a few months, we'll get another update. But what we can see here is that going all the way back to global trade volumes cresting on the way into 2021, we can see that catch-up growth there crests and starts to roll over. And from there, as stimulus influences fade, as that catch-up influence fades, you start to normalize on global growth. And so you see that there's been this gradual downshift in the growth of trade for China and for the globe as a whole, and they've generally moved close to in tandem. But China's share of the pie has significantly declined. It was as high as 15% going into COVID. It's now down a full 2%, a little bit less, depending on how you want to round it. But when you consider that this is the most significant value add center for the global supply chain, or was, and in many ways still is, and when you consider that this is the world's second largest economy, a 2% change is a tremendously large shift. So this tells the story of why China has been so anemic. Now, they've tried to rekindle growth with an attempt to make borrowing cheaper at home, and so to try to ease their way from a monetary perspective toward having people borrow more and make up for what's been lost externally with domestic demand. That's not really been working. So obviously we just saw here that the service sector, which would be emblematic of this, has not continued to maintain momentum. It has faded. And we can see why. So if we look at how effective stimulus has been, well, we can see here that as of July, new loans are not exactly rising. As a matter of fact, they are going in the opposite direction. Both new loans and total outstanding loans, if we look at year-on-year growth rates, both are shrinking. So we're back to essentially the pre-opening normal after a bit of a surge in total loans when the economy initially reopened around that pop of activity. And the reason, ostensibly, why the stimulus isn't working to generate new loans is because it's not working to actually loosen conditions in China's credit markets. Here is a city measure of those financial conditions. The higher this index goes, the more difficult and the more expensive it is to get a credit, and the lower it goes, the easier and cheaper it is. And so what we're seeing here is there was a bit of a tightening right as things got open. Not surprisingly, people rushed to grab credit. That has since eased, but conditions remain tight. They remain restrictive. We've not seen China, through all of its stimulus efforts so far, with rate cuts, with liquidity injections, with a relaxing of some lending standard rules and asset buying rules. None of that seems to have really meaningfully created accommodative monetary policy. Financial conditions are still tight. And with that in mind, they're still restrictive of growth. So the idea that we're going to get a domestic pickup against this backdrop is somewhat suspect. So we're not getting a pickup externally. We're not getting a pickup domestically. And if we look at the way that Chinese economic data has been performing relative to expectations, in particular from about mid-April, we can see that it is deteriorating significantly. So in seeing this index below zero, what we see is that analysts' models are still rosier than reality has validated. That essentially, as we get these numbers out of China, where they match up against expectations, they're tending to undershoot those expectations. And so that means those expectations still are a bit off. They're still envisioning a stronger China than what's actually there. That, of course, creates the risk that we're going to get another downside surprise on these PMI numbers, as though to cement the idea that China is going to remain anemic for the time being, that there isn't really a positive growth story there, and the world's second largest economy is significantly hampered and misfiring pretty much on every significant front, on every measure of performance that matters. Now, some hours after these releases, we are going to get the U.S. PCE inflation number. And this is the Fed's favored measure of inflation. And the expectation is rather uncontroversially that this, like the CPI report for the same period, which is already out, this is going to show disinflation stopped in July, that inflation actually started to tick higher. And as ever, when looking at this situation in the U.S. relative to, let's say, Europe, what you see is that it's the service sector that is the culprit, that goods at this point are actually a disinflationary force. And that's what you see with that little yellow bit on the bottom in the June bar here, that over time, what you see is that goods inflation has deflated and deflated and deflated, and at this point is actually something that's pulling overall inflation lower by a small margin. But services here has been much stickier. It's rolled over a little bit. It's come down some, but this is where most of the issue seems to be. Now, the biggest contributor to service sector inflation is actually what's called imputed cost of housing for owner occupiers. In other words, they go and they guesstimate housing costs for people that own their homes and essentially assume that they move with market conditions, which of course they don't really, because mostly in the US you're looking at fixed rate mortgages that are locked in, and where outstanding mortgage debt at this point has an average interest rate of about 3.6%, so less than 4%, whereas real-time market mortgage rates are north of 7%. And so there is, not surprisingly, a very difficult time buying a home because the price is being uplifted since nobody wants to sell. And existing home sales and existing homes in general, the inventory of existing homes dwarfs that of new homes by a factor of close to 5. So, for example, new home sales in July were less than 1 million. Existing home sales were closer to 4 million. So very different magnitudes here, clearly. There is not a whole lot that the Fed can do about that. There's not a whole lot that the Fed can do about unsticking the housing market and essentially saying, well, if we presume that people who live in homes are as though they were paying rents, and rents are high because inventories for housing are low, and most people can't afford to buy, so they rent. If we assume that the Fed probably doesn't have a lot of agency there, they can't exactly tell people not to live where they want to live. They can't force people to sell their homes. They can't affect building on any kind of near-term scale, though, of course, how they influence mortgage rates influences home building, but with a very significant lag. So the place the Fed has focused, and we hear this from Jay Powell all the time, is services excluding shelter. So basically excluding housing. And there, the other big component is the labor market. And in the labor market, the issue still is this lingering mismatch between labor supply and demand. There's been a bit of relief on that seemingly in July. We just got job openings numbers that registered lower than expected, and a private sector hiring number from ADP that registered lower than expected this week. So maybe there's a bit of steam coming out of this at this point, but nevertheless, there's still a tremendous gap. The mismatch close to 3 million jobs, plus or minus 500,000. So what we're looking at then is still a place where, because of a shortage of labor, wages are being bid up, because the only way to compete in a shortage for people that demand labor and for whom supply is insufficient is on price. And for labor, that's wages. What that means is that from the Fed's perspective, in so much as you're not going to magically create more labor supply, even if you were to try to do that via a massive immigration program or some such thing, we can see by the example of Canada that's currently attempting that. It's not so easy. Even if you set yourself a very ambitious immigration target and have buy-in from the population, and it's a popular thing to do and you want to do it and you're actively trying to encourage it, it's not very easy to actually get it done. And of course, there isn't an appetite for that kind of thing in the US. The only thing then that stands out to close this imbalance and try to work down the kind of inflation where the Fed can be impactful is to hurt demand. And so there, the issue starts being, well, can we raise rates high enough to create enough of a negative response from the economy that there is a reduced demand for labor, and this imbalance closes, which begins to work inflation down. This is what the Fed is attempting to achieve here to resolve this inflation issue. And as these numbers tick up, though they won't be surprising, as I say, CPI has already telegraphed this underscores the fundamental issue that the Fed is facing, and why, even though we're seeing a bit of this cooling in labor markets, why the Fed is perhaps likely to continue to stick to its guns. What we see is that there's been a really meaningful upshift in the expected Fed funds rate 12 months forward from a given day, starting in about May. This is the markets kind of coming to terms with the banking crisis will probably not find immediate contagion at that time. May still in the future, but at the time, the banking crisis that started with SVB in March appeared to be contained. And also somewhere at the beginning of May, markets convinced themselves, rightly, that the debt ceiling debacle in the U.S. would not be anything that is catastrophic or anything that wouldn't be addressed. So the rate cuts that were there initially baked in after the banking crisis, we can see that big sharp decline in the orange line there, right around end of February, early March. That's the market saying, oh, well, there's a banking crisis, the Fed can't raise rates. That, and then a period of digestion around the pregame for this debt ceiling debate, that gives way in May. And there is a spirited rise in rates from about 3.5% to about 5%. Now, where this is a problem for the Fed is inflation expectations do not fall against that backdrop. They anchor around the 2% target, but they don't keep going down. which essentially means that since this is a 2-year break even, nothing can go wrong for 2 years, and then the Fed will be at its target. But if something does go wrong, then the Fed is working with about a hair's width of a opportunity here to get it right. If anything goes wrong, the clearances and the allowances for the Fed to kind of work policy around changing circumstances are next to non-existent. And of course, with everything that's going on in the world, lots of things could go wrong, if only in the Ukraine-Russia war and its impact on global inflation. So what we end up seeing here then is a Fed that, regardless of the initial signs of cooling in the labor market, is probably not going to really blink until it sees that its actions or its expected actions actually generate the response they want, which is falling inflation expectations, and give them the room that they need to where if inflation expectations get meaningfully below 2 going out 2 years, they could cut into raising them, which is, of course, a much more comfortable space for them to be in. What this means is that essentially while China is pulling into a direction of more stimulus and a situation where they're trying desperately to boost growth, the U.S. is going the other way. It's trying to rein in growth to pierce the labor market and get inflation expectations down. This is, of course, a very dangerous sort of thing for the global economy if we consider that the U.S. is about a quarter of the entire pie. China is about a fifth. The remaining 15% or so is made up by the Eurozone, and that's if we assume just these three economies' contribution. And that's about 57% of global GDP. The remaining 43% is actually much smaller, and the other three are actually much more impactful because the lion's share of that 43% are vendors supplying demand in the other three big ones. And so the other three big ones are even more impactful than this looks, because the likes of Canada and Mexico are dependent on U.S. demand, for example. Central Europe and the UK are in many ways dependent on Eurozone demand, and the likes of Southeast Asia, Australia, New Zealand, they're very much dependent on demand from China. So you have a situation here where these three economies are really the bedrock of global growth. The Eurozone, for its part, is essentially confirmed to be in recession at this point. We can see from the latest PMI numbers, we've now seen 2 consecutive months of shrinking growth. That's after Germany's economy already shrank in the second quarter, all of which seems to come together to eventually seeing confirmation in the coming weeks and months as data catches up, with there already being a recession in the euro area. So we have recession in the euro area, and China can't get off the mat. Meanwhile, the last remaining leg of resilience, the U.S., faces a Fed keen on slowing it. If all of these numbers that we're going to get over these next 24 hours reinforce this view, well, then the global economy and global growth doesn't have very much of a leg to stand on for very much longer. All of which bodes ill for stocks, bodes ill for cyclical and risk-sensitive commodities like crude oil, like copper, bodes ill for related currencies like the Australian dollar, the Canadian dollar, whereas haven assets like the U.S. dollar because of its unrivaled liquidity, and anti-risk assets like the yen, which tend to rise when the markets get defensive, they look like they may have more fuel in the tank for gains, as do bonds. In particular, at the long end, where safe haven demand tends to go, even as the front end holds up around this idea that the Fed might not be quick to lower interest rates. And that's, of course, because the front end is more sensitive, and so not a very good sort of vehicle for safety, where volatility is what you're trying to avoid, whereas the long end, more stable, less sensitive, and thereby safer. And that is macro money for today. Thanks very much for joining. We are, as ever, here Monday through Thursday every week, right after Overtime, which is a show that I co-host with Chris Vecchio, head of Futures and Forex here at tastylive, where we discuss the day's events and try to figure out what might be next. I'm back on with Chris for Futures Power Hour on Fridays. It'll be a particularly interesting one this week as we dissect August's U.S. jobs report. So definitely come and check that out. I'm back on with Tom and Tony for First Call on Sunday evenings as the markets come alive for the week in Asian trade. I am also writing for the News and Insights section of tastylive.com. In fact, a summary of this very conversation is there now. And issuing pithy commentary on Twitter, yes, Twitter, at Ilya Spivak. If you're watching this on YouTube, jump in the comments, share your thoughts. Are we on the cusp of global recession? Are we going to duck it? Is the Fed going to jump off the rate hike cycle soon enough for global growth to squeak by? Or do we have a more meaningful downturn in front of us? Share your thoughts and we'll incorporate them into the show. Thanks very much. See you tomorrow.